In a week in which the Federal Reserve had to cut interest rates by 25 basis points, signaling to the financial markets that all may not be as well or as good in the global economy as some may have thought. Both silver and gold spot price markets held strong, even with a brief derivative sell-off Wednesday, when the Federal Reserve announced its interest rate cut. The silver spot prices closing the week down around 20 cents, finishing the week around $16.25 per troy ounce, whereas the gold spot price is closing the week on a strong note, near 1,445 fiat Federal Reserve notes per troy ounce. The gold-silver ratio rose due to gold's outperformance versus silver this week. It still costs around 89 ounces of derivative silver to equate to 1 ounce of the gold spot price in fiat US dollar terms. This past Wednesday, before the Federal Reserve cut interest rates, I had the pleasure of speaking with Jeffrey Christian of CPM Group about a whole host of topics. We cover what in his experience are the key ingredients for silver bullion bull markets of the past and potential future. We also go back in time as Jeffrey recollects his experience as a market journalist covering the Hunt brothers in the late 1970s commodity bull markets. Before we jump in with Jeffrey, a brief word from our show's sponsor. SD Bullion is a high-volume, physical precious metals dealer here in the USA. If you are acquiring an investment-grade bullion position, be sure to bookmark www.sdbullion.com/deals, where each and every week we source some of the best bullion deals for our over 100,000 customers worldwide. At the bottom right section of our website, you can also easily subscribe to our weekly Bullion Deals mailing list, where you will receive weekly notifications of valuable product deals that may be exclusive only to our SD Bullion mailing list. Stay tuned to sdbullion.com, the lowest price, period. Welcome to this week's Metals and Markets Wrap. I am your host, James Anderson of SD Bullion. With us this week, a returning guest is Mr. Jeffrey Christian, Managing Director of the CPM Group. Jeffrey, thanks for coming back on our podcast.
It's good to be here.
So, Jeff, last time we spoke, it was early March 2010, and obviously since then the spot prices for the monetary precious metals, I suppose you could argue silver still won, partly, and gold as well, have been climbing a little bit. So maybe give our listeners an update, what you see, what's been driving gold spot prices, and possibly what may come to help push gold prices further.
Yeah, I'm going to make a little bit of a cautious sound in it. I mean, we have seen gold up $185 or so, and silver is up $1 or so. But I'll get back to my reasons for caution in a second. What you're seeing is that as the economy moves forward, there are continuing to be concerns about the economic strength and viability in the United States and in other parts of the world. The trade wars have continued to weigh heavily on economic activities. You have a lot of weakness that is now showing up, not just in the United States and in China. It's very spotty. But you can see that this is weighing on economic activity. Also, a lot of the things that were stimulative of the stock market last year probably won't be repeated this year. Stock market's doing okay, but it's we're a year further down the road, and in that kind of environment, investors. What we find around the world is that investors say, we're worried about all these long-term issues. But in the short term, we're staying in the stock market and U.S. real estate and the dollar because they're still rising. And at some point, we're going to pivot over to gold and silver, but not until the economic and political environment is even more hostile than it is now. Now, looking at what happened with the price increase, that's where we're cautious. Because if you look at the price increase, it was the last 2 weeks of June. And since then, the silver price has been stronger, but the gold price has actually treaded water. And if you look at what was happening in the last 2 weeks of June, you saw very strong increases in trading volumes on the COMEX futures and options. in the London trading over the counter market and in the ETFs. In the gold shares, you saw it in those shares that are in major indices. And what you also saw was very low physical demand, and almost universally around the world, wholesalers and retailers said that physical holders of gold and silver were taking the opportunity of strong prices to sell. So you didn't see a lot of physical demand. What you were seeing was a lot of shorter term investors who participate in futures, options, forwards, and ETFs come into the market. And there really hasn't been that much follow through in the gold market. There's been more follow through on silver because some of those people who did well in gold in the last 2 weeks of June have, over the course of July, started repositioning themselves long in silver. But it's a little bit worrisome that it was a one-time thing because these guys are very opportunistic. They'll go long, they'll go short. And right now, I think that they're waiting to see a directional indication as to whether or not to go long or short.
Got it. Okay, so I was wondering if you had seen recently, there's been a lot of discussion about big physical flows of silver into SLV. Now, SLV obviously has been around since 2006, and ever since 2011, essentially the inventory level has been fluctuating around 300 to 350 million ounces. I guess in the last month or so, there's been about almost 60 million ounces flow into SLV. So it's kind of a two-part question. First of all, I just don't even understand exactly why GLD, for instance, the inventory in the GLD kind of correlates with the gold price up and down, and whereas SLV, it seems to kind of stay stable. Is it just simply more the fact that silver is a commodity, versus, I'm not really understanding why there's really little correlation between price rises and the inventory and changes, etc.
It's something that we've discussed and considered and analyzed for years, really since the bear market several years ago. And in gold, platinum, and palladium, you'll see greater price response in the buying and selling of the ETFs. But in silver, it's a much more sticky amount of metal. And the best explanation that we've been able to come up with is that if you look at the gold ETFs, when they were created, 2004 and going forward, you had a lot of people who formerly were gold equity investors or formerly did not get involved in gold come into the gold market. And again, they're shorter term, they're more opportunistic type of people. But in the silver ETF, what we believe you saw when it was created, when SLV was created, was a lot of people who owned silver, maybe 1,000-ounce bars, maybe coins and such, sold their physical silver and converted their silver position into SLVs. So we think that the ownership of the SLV shares represents people who are long-term silver investors who simply felt that that was a better way to own their silver than the old physical silver they had before the SLV existed. And that's why it's stickier. So we think that you've got a lot of long-term investors, and that's based on anecdotal information that we get from investors who used to own 1,000-ounce bars, and their wives would say, get that garbage out of the basement. And then when the price of silver rose sharply, we were getting calls from clients who said, I bought a silver 1,000-ounce bar in the 1990s when the price was $3.50 or $5.50. How do I sell it? Right. And so I think that what you've got in this SLV is a lot stickier long-term traditional silver investors, where the GLD is more shorter-term opportunistic people who have come newly to gold rather than silver, rather than gold shares are not being involved in gold at all.
Now, when we talk about either of those ETFs, they have APs, authorized purchasers who are allowed to take physical withdrawals from it, whereas a retail customer can't do that, obviously, or even a large hedge fund probably is not qualified to take physical flows or pulls from that the metals that are held within those two. So I guess, just when I think about it in my own mind, I presume that a lot of the gold that's sitting in GLD sometimes gets taken out for some of the demand that's in the East. Perhaps some of those bars are moving eastern to India or to China.
Whereas the silver part, I still, it's hard for me to totally understand why the APs maybe aren't pulling it out, because silver is not in that high demand as a commodity at the moment, perhaps, or it's just, to me, I find it, a little bit confounding.
The APs don't necessarily, I mean, to some extent, they are market makers and they don't necessarily act on their own behalf. They act in response to whether their clients are buying and selling. It's very funny because like a few weeks ago, I got this query from a client and he said, people are making a big deal out of the increase in GLD holdings. And they're saying, where'd all this gold come from over the last month or so? And we said, well, if you look at the chart just from January 2019 forward, GLD has clawed its holdings back to where it was at the beginning of January. And that gold that was put into GLD shares in June and July was gold that had come out in January, February, March. So when it came out, a lot of it didn't go off to Asia or anyplace else. It went into market maker inventories. As a market maker, you're a buyer or seller of last resort. And if your investors are selling gold but no one wants it, you put it on your books and you hedge it. And then when they want the gold again, you've got it. And I think that was what was going on with GLD. But again, silver, you haven't seen the big withdrawals. And the interesting thing is, we've seen it's about a 30 million ounce increase in silver holdings at the various ETFs over the last 6 weeks. And that's interesting that silver has come in there, because our view was that the physical silver market might have been a little bit tighter than that.
Yeah. Interesting. Well, Jeff, last time we had you on in March 2019, we did allude a little bit about the Hunt brothers, and I wanted to, allow you the space to kind of talk about your experience in that time frame. I've read your book. You have a great book called Commodities Rising that you wrote in 2006, and I enjoyed, reading that book. I thought there was a lot of sound advice in that book, and if you could go back maybe to the days when you're working at Metals Week in the late 1970s and early 1980 time frame, and give us a little bit of maybe a recollection of how that whole story went about, the Hunt brothers.
Yeah, I was working as a reporter following commodity markets, energy and metals markets. I had written a book in 1979 on electric vehicles. So I was doing commodities-oriented reporting. And it was interesting because at the beginning of 1979, people were not covering gold and silver because these markets were dead. But the Hunts had actually, the Hunts, we first stumbled over them when I was in university. The Hunts did some trading in soybeans and in silver, 1974, 75. And so they were out there and they liked silver and they looked at it. And I knew them. I talked with Nelson Bunker Hunt quite a bit and interviewed him several times, but I also knew all of the other players in the market too. So I had a ringside seat for what was going on there. And my take was that the Hunt brothers looked at silver the same way I did then and do now, which is, here's a market that is tight, but it's not being reflected in the price. And sooner or later, there's going to be this wave and it's going to take the price higher. And they wanted to take advantage and ride that wave. I don't think they wanted to create that wave. I don't think they were trying to manipulate the market. They saw that the price was going to rise at some point, and they wanted to participate in the upside. So they bought a lot of physical metal. I think about 65 million ounces of physical metal. And then they were also buying futures. There were no options on the exchanges. There was a company that was part of Makata and Goldschmidt at the time that had been grandfathered into silver options. But they mostly bought futures. And my take was that they wanted to ride that wave. And they saw that as that wave was emerging, they could possibly help accelerate it. So there were various brokers and dealers who were buying metal for them and servicing their accounts. And those people were saying, this is really interesting. And the Hunt said, well, if you want to tell your other clients what we're doing, that's fine. And they went off to see their friends in Brazil and Saudi Arabia and Paris. And they were telling everybody who would listen, we think silver prices are going to rise and rise sharply. Now, stop at this point and go back to 1979, 1980. And a lot of people blame the hunts and say the silver price from $5 to $50 was entirely the hunts. But if you look at what was going on, we had 14% inflation, 21% interest rates, American hostages in Iran, Soviet troops in Afghanistan, the oil price quadrupled, the gold price went from $200 to $850, copper went from 65 cents or so to $1.80. Clearly something was going on far beyond the confines of the silver market. And what was going on was that wave that the hunts had anticipated. Yeah. So they rode that wave and they allowed everybody to know what they were doing, and other people poured in too. I can't remember what the acquisition price that we estimated that the hunts had, but it was far below $50. They bought early and then they let everybody else carry on buying later.
Mm-hmm. Now, the changes that the CFTC kind of came in and made, obviously that changed a lot. If you basically tell the silver pit that they can't go long and it's liquidation order only, it essentially cuts the legs out from the price potentially going higher. I mean, is that essentially what occurred? I mean, the Hunt brothers essentially got their knees capped, basically.
Yeah, I think the Hunts made a couple mistakes, logistical mistakes. First, it wasn't the CFTC; it was the exchanges themselves. And a lot of people say, well, the exchanges changed the rules, and they didn't. The rules were there, and the Hunts should have known it. And the rules stated that if the markets were in severe dislocation, the exchange committees had the rights to take such steps as were necessary as to preserve financial order. And because, we didn't have a lot of financial futures back then, we didn't have a lot of currency futures trading and such, silver and gold were much more important in the economy and in the financial markets than they were. And because the Hunts were taking out profits out of their silver and buying stocks, as they got into financial difficulty, they were selling stocks, which led to a sharp decline in the stock market at the time. But the Hunts, one of the mistakes the Hunts made was they didn't realize that the exchange would take whatever steps were necessary to preserve order. So they came up with liquidation-only orders. And that was the unwinding of that upward pressure on the silver price. But it wasn't that the exchanges changed the rules, it was that they imposed them. And the Hunts should have known that, because for all of the criticism that the exchanges took then, if you look at other metal exchanges in other countries, they were often, much more often, imposing liquidation-only orders when there were congestions in various metals prices. They would say, okay, wait a second, we have to restore order here.
When you look back on it, what is the ultimate largest myth that still is pervading, you think, about the Hunt brothers? Is it just simply that they were the ones that pushed the price up to 50, or is it something else?
Well, a lot of people say that the Hunts were squeezing the market or that they were trying to drive the price high. And, from my conversations with them and from what I saw in the market, I'm very comfortable in saying they were not trying to manipulate the market, and they were not trying to squeeze the market, and they were trying to ride that wave. And I think that's probably the biggest myth. And then, the secondarily, the idea that the price went from $5 to $50 solely on account of them. Look at what was going on in the world at that time. And some of it we didn't even learn about until later with the Iran-Contra hearings. But, it was a really nasty time in the world. And, again, going back to what point I made earlier, it was a time when you didn't have a lot of ways to hedge your exposure to stocks and bonds and currencies other than gold and silver.
Yeah. Interesting. Well, thank you for going down the path with us here and giving us your recollections. Now, you've been in the precious metals markets, at least, as a journalist to begin, and obviously at CPM Group since the mid-1980s. I wanted to understand, perhaps from your perspective, what do you think are the key ingredients for that kind of explosive wave of silver prices that tends to happen historically on like a 2-year run typically? What are some of those things the key ingredients that you need to see for silver to do that crazy stuff it does occasionally?
Well, I think you can start with the silver market. And the two big ingredients in the silver market are tight supplies which I think you have now. I mean, you have 1 billion plus ounces in London inventories, but that's not particularly a lot of silver. And it's much of it's silver at rest. It's not going to come into the market. You have to have tight supplies, and then you have to have investment demand rising. And what we've seen over the last 2 or 3 years is investment demand has fallen to very low levels. So I think what you have to see is investor demand rise. And when that happens, especially if you have tight supplies, then the price of silver rises sharply. So what does it take for investors to buy more silver? Then you get outside of the silver market. Part of it is the silver fundamentals. If investors know that the silver market is tight, they'll be interested in it. If they know that it's well supplied, they'll be less interested in it. Although I have to say, if you look at past rallies in 1979, 1980, or 2007, 2011, the price of silver rose with far more silver, billions of ounces of silver in refined bullion inventories that don't exist today. So the silver market was very well supplied, and the price still rose sharply in those two instances. And we're in a much tighter situation now, which makes you that much more bullish. But the real kicker is what stimulates that investment demand. And most investors buy silver not because they think the silver market's supply demand is tight, primarily. That's a secondary thing. Most of them buy it because they're worried about currencies or bank stability or stock markets or economic activities or political problems. And so, you have this menu of like 5 or 6 categories of economic, financial stability issues and political issues that you have to pay attention to. And when those things get to really critical levels, then you see investors come in. It was the case in 79, 80. It was the case in 2008, 2009, 10, 11. And it probably will be a case again. I'll just say one thing.
Sure.
One of the central banks, I think it was the Bank of England, yesterday said to the banks under its jurisdiction, they needed these living wills in place by 2021. It's coming, I'm sure you'll talk about our long-term view of it. These are things that people have been saying since 2008, 2009. These banks must have living wills that allow for them to be rolled up in a severe financial crisis. And from 2008, 2008, 2009 until 2019, there have been delays in getting adequate living wills in place in a number of banks. And I think it was the Bank of England that yesterday said, no, you need those living wills in place by 2021. And the Fed came through with its statement, I think a week or two ago, it must have been 2 weeks ago, where they reviewed major banks in the U.S. financial market. And they said all of these guys need to tighten up. And these 5, I think there were 5 banks, they said, you guys really need to improve your system. So it's interesting because bank regulators are looking at the long-term outlook, and they're saying we really need to get in place the protections that we didn't have in place in 2008.
Right. I mean, that kind of goes back to when late 2014 when the G20 signed on to the bail-in supranational legislation, correct? I mean, they've signed on at least to an agreement that if there are further bank collapses, that they would holistically agree that bank bail-ins would be preferable over bank bailouts. Right. And so I'm supposing that they're just turning around and reissuing this to people or to banks that perhaps did not sign on or perhaps are not believing they're in that jurisdiction. But the signs that Christine Lagarde is being potentially thought about as being the head of ECB, I mean, these are important tells as to what potentially could be happening in Europe in the coming years. So I appreciate you bringing that up. I mean, it's really important that people understand that just because you give your currency to a bank doesn't necessarily mean it's all perfect and it's all going to work out. Sometimes banks do have trouble. I wanted to ask you if you guys are still feeling bullish as far as gold and silver prices in the coming years. I know that you guys were on record a year or two ago talking about the potentiality of gold reaching near again nominal price highs in the coming years, and silver threatening those former price highs in the coming years. So I wanted to give you a chance to perhaps reiterate if that is still what you guys are thinking.
Our long-term view is that both gold and silver are tight and tightening markets, and that that will supply some upward pressure on prices over the next few years, along the lines of what we really seen 2015, 2016, and since last month. We think that the prices move modestly higher, but that then we step out of ourselves and we say, for all of the economic strength that you're seeing, this is a much more treacherous world than it's probably been since World War II. And at some point, there's probably going to be another crack. And you don't have to be a gold bug to say that. The Bank of England's saying it to their banks, Yeah. And we think that when that happens, the gold and silver prices will rise sharply because investors will pour into gold and silver. And there won't be, there'll be billions of ounces of gold around, and there'll be a billion or more ounces of silver around, but the people who own that are not going to be ready sellers in a rising market, in a rapidly rising market. So we think that the prices of gold and silver probably will rise, and the question is, when does that financial crisis become so severe that it causes that? And our best guess is that it might be 2023, 2025 before it happens.
Yeah, right. So it's not inevitable, perhaps not tomorrow, but you have the Bank of England saying, by 2021, hey guys, get your living wills in order. And so potentially we see something in the coming years, maybe not this fall, like some people might think, but in the next few years, a lot of this trouble may come to a head.
That, the key point, it could come at any point. But you've got to, if you go back to late June, it wasn't that the Fed said or did anything particularly dramatic, but the financial market's interpretations of what the Fed said is what drove gold and silver higher in the stock market. And that's probably going to happen this afternoon too. When the FOMC comes out with its statement now. But it's the perceptions of what's going on that's going to really matter. And you get into this weird situation, where you could have a constitutional crisis in the United States, and the president could be removed from office, and that could be seen as a bearish factor for gold and silver. Because the resolution of problems that are hanging over the global economy.
Sure. Well, Jeffrey, I really do appreciate you coming on our show this week. If there are any other, I want to give the listeners a way to go and find your work and to see what you're up to. So how do they best do that?
The best way is to go to www.cpmgroup.com. We have gold, silver, and platinum yearbooks that we produce every year. They're very good entry-level reports. They're about $160 each, but you can order them online. And they give you both a tremendous amount of history and also a very good analysis of where we think the markets are this year and heading.
Well, Jeffrey, I just personally have used some of those books and the research that I've done for different blogs that I've written on our website, and I really do appreciate the work you guys do. I think it's really excellent, and I enjoy it. So yeah, listeners out there, if you really want to delve deep into the markets, check out Jeffrey's CPM Group's books. They're really good. So thanks again for coming on the show this week, Jeffrey, and I hope to get to see you again maybe later this year.
Thanks for inviting me. It's a pleasure to be on your show, and let me know when you want to talk again.